Hi, this is Keith Schneider, co-founder and CEO of MarketGauge.com, and this is August 19th, 2012 edition of Market Outlook. Don't forget to participate in our investor sentiment survey, and we'll be sure to send you the results. Additionally, if you like this and what you're hearing, please sign up on our website for the free newsletter, and you'll get this every week delivered to your inbox. So, interesting close for the week as we closed on new highs. This week, let's take a look at the spiders, interest rates, the overall market internals, and we'll take a quick look at what the charts in Russia and China are showing. So first of all, what we want to do is highlight the fact that we are quite overbought on very, very low volume, and we're sitting right at the all-time highs for 2012, and also just before the financial crisis really fell apart. You can see how we just touched over here on the 65-week moving average. Right now, we touched down on the 65 several weeks ago, and now back up to the all-time highs for the year, and also touching the highs just before we completely fell apart. So we're at a very, very interesting point. Now, again, please note that we are overbought on the RSI on the daily chart. As we have moved to new highs, the volume is the lowest it's been really since the beginning of 2007 or so. So low volume rally. Let's also take a look at some of the longer term charts. You can see that very similar picture is playing out, but when you look at the overall picture, yes, we've gone sideways for the better part of 10 years, but we are approaching the upper end of the range. So please take note of that. A very important trend line has been able to be put in now that we're basically at the new highs. So you have this 2-point trend line here, and again, if we break down on the monthly charts beneath 124, which is quite a distance away, but still very, very important to take note that we'll be breaking down beneath this 80-month moving average, as well as a potential trend line. So those are some critical levels to watch for. Let's take a look at some of the market internals. The VIX indicator, you can see we're going to go to the daily chart, which I find a little bit more useful for the type of trading that we do, which is a little bit shorter term in nature, is that you can see the red line here, which is the bottom of the Bollinger Band. We actually have moved down, but are a little bit further away than we were starting the prior week, as the trend line or the bottom end of the Bollinger Band is moving sharply down. So sentiment very, very strongly bullish, as reflected by the VIX volatility index here. This is a sentiment based on implied volatility of the options on most of the S&P stocks. And so here you have a situation where we're trending down, but it's not indicating extreme exuberance. So are we trading at the lower end of the range? Absolutely. In fact, this is the lowest it's actually been on a closing basis all year, and also for several years back. So you can see sentiment is definitely turning even more complacent, but again, not over so. Well, let's take a look. Let's actually look at the weekly charts and see how far we go back to these type of levels. So you're talking as far back as 2010, and we haven't hit these levels since really about 2007. So the sentiment is clearly pointing to continued improvement in the market until further notice. Let's take a look at the other market indicators. McClellan oscillator, you can see it's winding its way up to the upper end of the of what I would consider a pretty normal trading band, but we are still coming off of a buy signal on a more intermediate, or what I would call looking out over 1 to 3 weeks or so. And as you can see, it's been playing out pretty nicely. Again, last week we noted that we got a buy signal on the McClellan oscillator back in mid to late July. However, our shorter term indicators are definitely indicating the fact that we're a bit in the higher end of the range, and we've hooked down. Now, what we like to see is confirmation between the advanced decline and the up-down ratio. What we have is a hook down at a level that would indicate a sell signal, but not really confirmed fully yet by the advanced decline. So in conjunction with the overall readings on the RSI and the readings on the market internals here, we've got a pretty mixed picture, but we definitely are getting a little bit long in the tooth, and it looks like we've got about half the evidence pointing towards a bigger intermediate, or I would say several day correction here at a minimum, but that's only half the indicators. The others are pointing positive. So you got a mixed reading with the overall trend extremely positive on the intermediate term level. Let's take a look at bonds. In bonds, you can see on the daily chart we hit the 200-day moving average. At the same time, we became a bit oversold on the RSI. So we covered a portion of our position down here. As you know, we've been talking about this lack of confirmation on the new highs with the TLTs, which is the 20-year bond ETF, as well as the fact that you had a key reversal pattern, or what we would call a slingshot pattern, and we've been basically trading it with options on the betting on a fall in price. So it'll be interesting to see if this 200-day offers support, and actually we get a bounce off of here. Let's take a look at the weekly charts. As you can see, the weekly charts are also indicating an oversold condition. So this is pretty interesting, the fact that the daily and the weeklies are confirming the fact that the market's pretty steeply oversold here. However, if you want to look at it in terms of where the moving averages come in, you can see around 115 or so would be pretty good support on the weekly charts. So meanwhile, we're indicating a potential short-term bounce here. In terms of the daily charts, it'll be interesting to see where this where the strength materializes. Remember, we have a strongly trending or a sloping up weekly moving averages. That's definitely going to lend some support to this market. But meanwhile, potential top is in place, and these tops could take a while to form, and so you can definitely see a short-term bounce, maybe another test of the 50-day moving average, which comes in around 127. And also take note that it is a declining 50-day moving average, so that should offer some level of resistance if we do get that bounce. Well, let's take a look at some of the foreign markets that we have highlighted in our text and commentary. So the first one is China. And as you can see, that the Chinese stock market has basically been sort of stuck in low gear and has barely recovered from its highs that put in earlier this year. So compared to the U.S. markets, you can see FXI, which is the ETF for China, is definitely looking much weaker. And we also are in a situation where we're trading under the 200-day moving average. The 50 is not very convincing. The slope is, I would say, flat to neutral, maybe even down a little bit. So what we're in here is sort of a weak recovery phase, but on a relative basis, we're clearly underperforming the U.S. equities market. And if we go back and take a look at a longer term chart, let's look at the weekly chart. You can see that since 2008, when the markets, all the global markets really fell apart, that we're not nearly as close to the point from where they broke down as we are in the U.S. equity markets. So there's definite some deterioration in the growth of China. There's some political confusion and uncertainty there with the trial of some of the party leaders on murder. So political stability for some investors might be called into question. Not really good for long-term investors if they're feeling uncomfortable about the political scenario. Now, similarly, Russia is going through its own type of issues, not dissimilar from China. Let's take a look at RSX, which is the Russian ETF for their stock market. Let me bring that up here. Let's see. Okay, so you can see the Russian stock market also having a lot of trouble this year. Let's take a look. You can see that since the highs were put in March and early March, late February of 2012, that the market was trading as high as 34. We're now down to about 27, 28. You do have this compression under the 200-day moving average. So it'll be interesting to see how things play out here. You have a high degree of consolidation. So the market's sort of at an interesting point. The issue is, will it shrug off some of that political news? There's lots of stuff swirling around in the press about the Kremlin and Putin's reign as being corrupt and not sustainable. So here you can see the sideways action in the market and not that much of a recovery. So again, the market here in Russia under pressure. You could easily see another, if we can get through this 27 level, 2690, you can certainly potentially see a test to start down to the 26 level, which is right around this moving average of 2630. But more importantly, it looks like it's very possible that you might get a test of these lows. On the other hand, to look at it from the bullish case, you've got enough compression to certainly power you through this 200-day moving average. But on the other hand, you also have a tremendous amount of resistance just above. So my guess is that the structural issues both in China and in Russia are going to have them stand out as underperformers relative to the rest of the global equity markets. So anyway, that's it for now. Hope this was helpful. Have a great trading week. We are going to take a needed hiatus, and we'll be back at the beginning of fall and after the Labor Day weekend. So have a great rest of the summer, and see you then. Bye for now.